Welcome to Talk Tickers. We're your shortcut to, well, getting smart about earnings calls without wading through hours of audio. Today, we're diving into Lululemon's Q2 FY2025 results. And it wasn't exactly a straightforward quarter. Definitely some contrasts in there, lots for investors to think about. So our mission today, guide you through the key numbers, what management actually said, and the big strategic shifts that might just define Lulu's future.
Yeah, you're right. This call was a fascinating case study, really. You've got conflicting signals all over the place. Some numbers look strong, especially overseas, but some pretty serious headwinds popped up too. It led to a big reset on their outlook, and we're going to unpack why the market reacted, well, quite so strongly to it all.
Okay, let's jump in. The headline numbers for Q2 FY 2025. So GAAP EPS came in at $3.10. That's generally accepted accounting principles earnings per share. Basically, their profit per share by the standard rules. And that $3.10 actually beat what analysts were expecting, which was around $2.88. So sounds good, right? A positive start.
It does, yeah. A beat on the bottom line is always welcome. But then you look at revenue, that came in at $2.53 billion, just a touch under the $2.54 billion people were looking for. So a slight miss there. Top line growth was still positive, up 7% year over year. 6% if you strip out currency fluctuations, what we call constant currency. It gives a cleaner picture of just the business performance itself.
Okay, so beat on profit, slight miss on sales, a bit of a mixed bag, like you said. But the really interesting part, I thought, was inside those sales numbers.
Exactly. That's where the story gets complex. Total comparable sales. They only grew 1%, just 1%. And if you dig into that, the Americas, so mainly the US and Canada comparable sales actually declined 4%, 3% in constant currency, which is just, well, a stark contrast to the international side. That surged 15% on a comparable basis, 13% constant currency. So right away, you see these two totally different stories playing out. Why is the home market struggling while international is booming? That's the big question.
Yeah, it's like two different companies almost. Hitting high notes abroad, but maybe hitting a flat note at home.
Yep.
And beyond sales, profitability took a hit too, didn't it?
Yeah.
Gross margin down 110 basis points. That's 1.1 percentage points, right? To 58.5%.
Correct. And operating margin also dropped by 210 basis points or 2.1 percentage points down to 20.7%.
Inventory, that jumped quite a bit. $1.7 billion, up 21% in dollar terms year over year. 13% in units.
Right. And that rising inventory, especially when sales growth is slowing like this, can be a warning sign. It often means markdowns might be coming down the line, which puts even more pressure on those margins. Now, they did end the quarter with a decent cash pile, $1.2 billion, and bought back some stock, about $278.5 million worth. That's usually good for shareholders. But, connecting it all, the market's reaction to these numbers plus the new guidance they gave, it was sharp, very cautious, actually moved more than options pricing suggested, which usually means investors were a bit caught off guard by how challenged things looked.
Okay, so the numbers paint part of the picture. But to really get the why behind the U.S. struggles, we need to hear what management said. And Calvin McDonald, the CEO, he seemed pretty upfront about it.
He was, yeah. Quite direct, actually. Expressed disappointment with the U.S. results and even some aspects of their product execution. He flagged a specific problem, saying, quote, "Product life cycles run too long within many of our core categories, particularly in lounge and social." Essentially, the casual stuff was becoming, in his words, too predictable, which isn't great for a fashion-forward brand. Core lines like Scuba, Softstream, Dance Studio, they just weren't hitting the mark like they used to, especially with their best customers.
Too predictable. That's quite an admission for Lulu, isn't it? They built their name on being aspirational, on leading trends. So, okay, they know there's a problem. What's the plan? How are they going to fix this predictability issue?
Well, it's a multi-pronged response, heavily focused on product, as you'd expect. They're pushing a big assortment refresh. The goal is to get new styles up to about 35% of the spring lineup. That's up from just 23%. And this push is being led by their global creative director, Jonathan Chung, who came on board early last year. His job is basically to inject new energy, especially into lounge and social and, update some of those tired, iconic pieces.
Right. So more new stuff makes sense. But can they do it fast enough? Fashion moves quickly if things were running too long before.
That's the crucial question, isn't it? Agility. Management talked a lot about improving their go-to-market process, speeding things up. They mentioned working with vendors to chase into styles that are selling well, basically, order more quickly if something's a hit, and using fast-track design capabilities to cut lead times by several months on some items. That could be a game changer if they can pull it off consistently. They also brought in a chief AI and technology officer, Judas, a new role specifically to use AI and tech to speed up innovation, react faster to the market, maybe even personalize offers better. Think AI spotting trends before humans do.
Using AI for fashion trends. Interesting. Seems like a necessary move these days. But okay, while all this focus is on fixing the U.S., that international business, as we said, is just booming. It's like night and day.
No. It really is. International is the massive bright spot right now, providing that crucial growth offset. Revenue internationally shot up 22% or 20% in constant currency. Comp sales up 15%. That's really strong. And China mainland, which is their second biggest market now, saw revenue jump 25%, comps up 16%. Just phenomenal growth there. And they're still expanding too. Just opened in Italy, planning for India in the second half of 2026. So the global brand appeal is clearly still there.
Absolutely. That global strength is undeniable. But
Yeah.
just as they're trying to fix the product engine, this other big problem landed on their doorstep, the U.S. tariff situation.
Yeah, this is a major curveball. The big change is the removal of the de minimis exemption. That kicked in August 29th. Basically, for our listeners, this rule used to let Lululemon ship a lot of its U.S. e-commerce orders from Canada duty-free as long as the package value was under $800. It was a kind of loophole, gave them a cost advantage. Well, that loophole is closed now, and it's expensive. This change, plus some other tariff increases, they expect it to hit their FY25 gross profit by about $240 million. That translates to a 220 basis point hit to gross margin for the whole year. And get this, about 170 basis points of that is just from losing the de minimis exemption.
Is $200
million? That's huge. Just from a policy change, is essentially altering their logistics. Does that pain continue into 2026? It does, yeah. They're estimating the hit to operating margin in 2026 from tariffs and de minimis will be around $320 million. Now, they expect to have a full year of mitigation strategies by then, trying to find savings, adjust supply chains, maybe even some pricing. But it's a structural cost increase for doing business in the U.S. online, basically. It forces them to rethink how and where they ship from. And it raises that question, too. Can they pass this cost on through higher prices, especially when the U.S. market is already looking soft? And they mentioned isolating price changes to the U.S. for now, but we'll see.
Okay, so you've got the U.S. product needing a refresh, plus this massive new tariff cost. No wonder they had to cut their guidance. What are the new numbers looking like for Q3 and the full year?
Yeah, the revisions are pretty significant. For Q3, they're now guiding revenue between $2.47 and $2.5 billion. EPS is expected between $2.18 and $2.23. And look at the margins for Q3. Gross margin expected down about 410 basis points. About 230 of that is the tariff day minimis hit, and another 80 basis points from higher markdowns, likely due to that inventory build. Operating margin for Q3 guided down roughly 560 basis points, so big hits there. For the full year, FY 2025, revenue is now pegged between $10.85 and $11 billion. That's only 4% growth. Quite a slowdown. Full year EPS guidance cut to $12.97. Compare that to $14.64 last year. Big difference. They see America's revenue basically flat to down 1% for the year, with the U.S. down maybe 1-2%. But China's still expected to grow 20-25%. And they trimmed their capital spending plans, too, down to $720 million.
Right. That definitely paints a picture of a company bracing for impact, managing through some choppy waters in the near term.
Absolutely. It's that combination, isn't it? The U.S. slowdown hitting at the same time as these external cost pressures from tariffs. It's a reminder that even strong brands aren't immune. Management keeps saying the real benefits of their strategy changes won't really show up until 2026. So there's this gap investors have to navigate between the pain now and the potential progress later.
Okay, so let's talk about that. For you, the listener, maybe as an investor, what does this all boil down to? We heard management own up to the problems. They've got a plan. But the market's initial reaction was pretty negative.
Yeah. Stepping back, the stock dropped about 15% after hours following the call. That's a big move, bigger than options traders seem to expect. It really shows the market is zeroed in on the immediate problems, the margin squeeze, the revenue reset, maybe more than management's confidence about the longer term. The whole narrative seems to be shifting, from Lululemon as this untouchable leader just defending its turf, to an innovator that needs to prove it can reaccelerate growth. And the challenge is that time lag. The headwinds are here now. The benefits of the fixes are mostly promised for 2026. Bridging that gap is key.
And 2026 feels a way off in retail terms. So what should people be watching for? What are the signs that things are turning around or maybe not?
Good question. Key things to watch, I'd say. First, the Q3 results versus this new lower guidance. They absolutely need to hit that bar now. Second, watch those U.S. comparable sales figures closely. Are they stabilizing? or still declining? Third, and this is maybe the big one, how does the market react to the new spring products when they land? Is the assortment refresh actually working? Do people like the new stuff? And fourth, how effective are those tariff mitigation strategies? Are they finding savings? Can they manage the supply chain impact? And of course, does that international momentum hold up? Lots to keep an eye on.
Definitely. Okay, we've covered the serious stuff. Now time for our slightly less serious segment, but still thought-provoking. This is not financial advice corner where we toss around a hypothetical trade idea purely for discussion.
Right. And given everything we've just discussed about Lululemon, the idea that came up is kind of a classic patience play, but with a bit of a near-term hedge.
Okay, lay it on us. The idea is
you could consider going long a call option on Lululemon, but one that's way out of the money and has a really long expiry date. Think 2026, maybe even 2027.
so an option that only pays off if the stock recovers significantly, quite far in the future. Like a bet on that 2026 turnaround story management is telling.
Exactly. It's a conviction bet that the product innovation will eventually work, the brand strength will reassert itself, and the stock will bounce back strongly from where it is now. It's banking on that long-term recovery.
Okay, but what about all the near-term pain? The tariffs, the inventory, the weak U.S. sales we just talked about?
Right, that's where the hedge comes in. To protect against that immediate guided weakness over the next few quarters, you could potentially pair that long-dated call with something short-term bearish, maybe a put option that's already in the money, or even a small outright short position, perhaps expiring late this year or early next year, like Q4 2025 or Q1 2026. The goal there is to try and capture some potential downside from the current pessimism and the tariff impact really hitting the numbers while still holding that position for the potential long-term rebound.
So you're trying to play both sides of the timing difference, navigate the short-term dip while positioning for the long-term recovery.
Kind of, yeah. It's about acknowledging the lag between the current pain and the potential future progress. Again, purely hypothetical.
Got it. Okay, let's recap the whole situation then. Lululemon is definitely in a challenging spot. U.S. performance is disappointing, tariffs are a huge new cost, and they've had to reset expectations.
But they're not just sitting there. They have a plan focused on product newness, getting faster, and leaning into that really strong international growth. Management sounds confident about the long run, targeting 2026 for when these changes really start to bear fruit. The market, though, well, it seems focused on the immediate hurdles, the margin hits, the revenue slowdown. Patience seems to be the key word for investors right now.
So as you listen, think about it. Can Lululemon really innovate its way out of this predictability trap? Will AI and speed be enough to counter those tariff headwinds and reignite U.S. growth? What stands out to you in the recovery plan? And just remember, our chat today is for informational purposes only, definitely not financial advice. Thanks for diving deep with us here on Talk Tickers. We appreciate your time, and we'll catch you on the next call.